Mixo Das is the Asia Equity Strategist at JPMorgan. He's joining us from the sidelines of the JPMorgan India Investor Summit. Mixo, thanks very much. Great to have you with us here on the program. Thanks for your time. The question here in India, of course, I'm assuming that you guys are also getting at the conference is, at what point does the global sort of risk-off start to affect India? Or do you think we've got a bit of Teflon coating now? What's your sense?
It never lasts very long, right? Like if global equities start to fall 10, 15%, there's no way that any market will survive in that sort of an environment. So that's just a global perspective, right? Like most of the conversations we've been having around India has been much more focused on the India context. And as many speakers from the government and industry at the JPMorgan India Investor Summit have said, the long-term trajectory of India's growth has become much more clear post-pandemic, and versus the rest of the world, it looks especially attractive. So we've been grappling with this issue of very strong macro performance versus very high valuations in the India market. And all through 2021, we were basically ignoring the valuations. But right now, it is starting to look a little bit stretched.
Mixo, hi, good morning. So in that context, would you say that the risk reward now perhaps is not favorable in Indian market? And can it continue to sort of outperform and completely ignore the global risk off?
Yeah, so I don't think that's going to be possible. So as you've probably noticed in the past, India market had been following very closely the S&P 500. And in fact, this was true of all EM Asia ex-China markets, very closely following the S&P 500. Since early August or mid-August, we've started to see that kind of diverge, but India has held up much better than the rest of the other markets, including the S&P. And typically, this sort of divergence wouldn't tend to last. So I would expect some catch-up there. And just looking at the Indian market dynamics, right, you have a situation where earnings are well above trend and are starting to get downgraded at this point. You have valuations which are at 22, 23 times on a trend forward PE basis, which is 2 standard deviations above, and ERPs are at basically 20-year lows. And keep in mind that excess liquidity in India, in the domestic economy, which has been a big support to the market, is starting to face some pressure because you're starting to see credit growth pick up while deposit growth is slowing down.
Okay, well, for the Indian markets, you said that the long-term trajectory of Indian markets has become very clear now. Do you see this as some sort of, the start of a multi-year bull market in India, if we are not in the midst of it already? I ask because, we were just discussing how the retail demat accounts in the month of August hit that 100 million mark. So the equity cult has come back in a big way in India. Your thoughts?
There are 2 parts to this. Firstly, I think from a macro perspective, you're absolutely right. We are already in the midst of a multi-year bull market. But from a retail participation perspective, actually, we are probably closer to the end of very aggressive participation. And the reason I say this is because when you think about household asset allocation, there tends to be, with India's growth and development, there tends to be increasing allocation towards capital appreciation. And the problem has been in India in the last 10 years, the property market has gone nowhere. And as a result, all the capital appreciation, money has been put into the equity market. As the property market starts to pick up, which is our expectation, you could actually see the retail fervor in the equity market start to slow down a bit.
Okay. So if you're saying that India is now in the middle of a multi-year bull market, what kind of themes do you see take center stage now? I mean, so far it's been the old economy facing, themes, whether it's financials, IT. Of course, IT is not old economy, but now there's sort of, a change. There's so much disruption happening. What do you see as the big trends over the next, say, 6 to 12 months?
And this is part of a global trend where value has outperformed growth since the early part of 2021. And we think that this is going to be a multi-year trend. So we still like the financials. We still like the materials, energy companies, including in India. And we do think that that's probably going to be a place which does well over the next 12 months or so. But over a longer term, when you talk about 5, 10 years, right, obviously these disruption areas become very important. India has seen a large amount of VC interest over the last 5 years. And eventually those companies will come into the stock market, and that will peak retail interest as we go forward as well. So it's really going to be quite diversified. You have consumption growing via urbanization and growing incomes. You have value doing well, and certain parts of these value camps in the market doing well. And then you have the long-term growth performance via the disruption sectors, which will come through in multiple years as well.
Mixo, is geopolitics still a risk for the market, for the global market? This morning we're hearing some talk about, escalation in Russia-Ukraine situation. Of course, there's China angle all the time, but do you think that at the margin could still be a factor?
So India has, in fact, by our calculations, been the biggest beneficiary of capital rotation out of China. And this is not just from a portfolio perspective, but also from an FDI and manufacturing investment perspective, where we have started to see manufacturing in India, supply chain relocation in India pick up very aggressively. And that is something that we think will be a long-term trend over multiple years. From a portfolio investment perspective, there's been two phases where we saw in the initial part of rotation out of China in really the first half of 2021, we saw a lot of money going into India. But after that, we've seen massive outflows out of India. And only in the recent month and a half, I would say, we've seen foreign capital coming back into India. And this, again, has a very strong angle of geopolitical diversification out of China. The Russia-Ukraine angle, I would say that from an India market perspective, has less relevance. Only to the extent that oil prices, what happens to oil prices will obviously be very relevant for the Indian market.
Okay. By the way, Mixo, any thoughts on the big deals which we are seeing here in India? I mean, we've seen one of the largest in the cement space recently, and there's a lot of talk. There's a lot of talk that a lot more is coming. Any thoughts?
I mean, I couldn't comment on specific stocks or sectors, but I would say that this sort of M&A activity is not unnatural. What we're seeing from a very top-down perspective is that the cost of capital is going down in India, or the risk premium on capital that you pay in equities has been going down in India. And as a result, we are starting to see these sort of investments. And I would expect that this way of growing via M&A continues to be a long-term trend as well.
This restrictive monetary policy territory that we're getting into as far as the US Fed is concerned, right? I mean, it doesn't stop at the 75 or 100 basis points rate hike. We're expecting perhaps more cautious views and multiple rate hikes through the course of the year. How do you approach equities as an asset class? If you do have some powder dry, do you deploy it right now? Do you stay a bit cautious? I'm asking overall, not just for India. And what would the preference be between emerging and developed markets?
So I would say that actually, from a Fed perspective, the market is currently pricing in 75, 75, 50 in the next three meetings, right? So we'll get the first 75, perhaps 75 tomorrow evening, and we'll see how it goes from there. But I think the key thing to keep in mind is that the market is already pricing in these sort of hikes. And if you listen to the commentary from the Fed, they are incrementally moving away from fighting inflation today to trying to stop inflation resurging next year. So as this happens, and as we get the very large hikes priced into the market, you could actually be in a situation by the end of this month or going into October where you start to see the Fed becoming less of a headwind for markets. So valuations could end up re-rating a little bit into October, helped also by seasonality. But of course, at that time, we also expect some earnings downgrades across global markets. But that could kind of end up being a valuation positive versus earnings negative. So depending on the market and the specific dynamics there, it could be a positive or negative.
Mixo, thanks a lot for your time today and have a good summit. That's Mixo
Thank you.
From the sidelines of the JPMorgan summit. We need to take a break. The global markets are still a bit iffy. There's, of course, this wait for what the Fed might do this evening. Our market, of course, has been an outperformer, and on days like today, normally does not fall as much. In fact, sometimes does not even break the SGX Nifty lows. So we'll keep an eye on that, and we'll take a break. We'll come back and we'll address some of the important stocks that we are tracking today.